In the recent past, we have discussed two small cap and one large cap fund. But today, we'll be looking at a fund from a category that's not much talked about. The fund we will discuss in this video has seen its AUM go from around 1,300 crores in August 2020 to over 14,600 crores in August 2023. That's a growth of 10 times or 1,000%. And in these 3 years, it has delivered CAGR returns of around 39%. The fund we are talking about is SBI Contra Fund, and this fund has become investors' favorite in recent years. But why is this happening? Why are investors jumping onto this fund? And should you consider adding this to your portfolio? We will try answering this question in this video. Hello and welcome to the ET Money's YouTube channel. In today's video, we will look at the performance of the SBI Contra Fund. We will discuss why its AUM is skyrocketing and whether this fund is a worthy investment option. But before we start, a quick update. We have recently launched our WhatsApp channel. If you want to get access to our most insightful content, click on the link in the description and join our channel. और आप ये और हमारी बाकी सारी वीडियोस हिंदी में भी देख सकते हैं on our Hindi channel. Now let's start by understanding Contra Fund and how they invest. By definition, contra funds take a contrarian view of a business or a stock. They invest in stocks other investors are not paying attention to and are likely to turn around. But what do we mean by that? Let's understand this with one example. During COVID, hospitality stocks didn't do well for obvious reasons. There were lockdowns and people were not traveling. Now, contrarian investors would have looked at the valuation of such stocks and bought some that were available cheaply. Now, the main objective of such funds is to identify a turnaround story early on and buy stocks when they are available at low prices in relation to the potential returns they offer. However, there is no objective definition of contra stocks. Therefore, it is subject to interpretation by the fund manager. Now, you might wonder how this differs from value investing. Honestly, that's a tough nut to crack. But to avoid confusion, SEBI guidelines state that the fund house can either offer a contra fund or a value fund to its investors. We can therefore safely assume that they are closely related. So in our analysis, we looked at both value and contra funds as a benchmark for the fund's performance. Now let's look at the fund's performance. If you look at the trailing returns of the fund, then it seems like the fund has outperformed its benchmark and peers in all time frames. However, if you look deeper, the outperformance is high in the short term, but it's not apparent in 10-year investment horizon. So it is possible that the fund has performed really well in the past few years, which is also pulling up the performance for a longer time horizon. Now, to see if that's the case, we decided to look at the fund's rolling and annual returns. And what we found here tells a different story. The 3, 5 and even the 7-year rolling returns of the fund are in line with the category average and the outperformance is not evident. It points to the fact the fund has done well only in last few years. Finally, when we looked at the annual returns, it became clear that our initial hypothesis was true. If you look at the chart on your screen, it shows that it was only after 2020 that the fund started to outperform its peers. Before that, it did not outperform its category average in any period. This is a classic case of turnaround. From 2020 onwards, the scheme has performed exceptionally well and not only outperformed its peers but has done so by huge margins. This also explains why investors have flocked to the fund and its AUM has grown 10x in the past 3 years. But what are the reasons for this turnaround? Did something change at a fundamental level or it just happened because of the COVID-19 rally? We will look at possible reasons for the scheme's turnaround in the next section of the video. If we look back at the fund's history, there was a change in the fund manager of the scheme. Dinesh Balachandran was appointed the new fund manager in May 2018 and has managed the fund since then. Now, if we look at the fund's returns, the period of outperformance coincides with the change. So, it is possible that the new fund manager's investment style is making the fund deliver stellar returns. To find out if this is true, we decided to look at the portfolio in detail, and some numbers did stand out. Firstly, there is a significant change in the fund's turnover ratio. What it means is that the fund manager is frequently churning the portfolio. Since the new fund manager has took over, this ratio has increased multifold. It went from being 44 in 2018 to 124 in 2019, and as of August 2023, it is at 230. Now, if you compare its turnover ratio to all the funds in the category, it has the highest turnover ratio. Now, this could be a potential factor that is contributing to the improved returns of the fund. However, there is no back-tested study that shows a high turnover ratio can give high returns over an extended period of time. But one thing is clear, the fund manager doesn't follow the buy and hold strategy. The next thing that stood out was how the allocation to large, mid and small cap stocks are changing in this fund. Now, the scheme under the old fund manager had the largest allocation to large cap stocks. However, since the new fund manager has taken over, the allocation to large cap stocks has gone down while the allocation to mid cap stocks has increased. We wanted to look at it a bit more in detail and decided to evaluate how the scheme stacks up with its peers. And we found that the fund ranks 5th in the category in terms of exposure to mid and small cap stocks. Now, this high allocation to mid and small caps can also be another factor contributing to a fund's improved returns because historically they have delivered better returns than large cap stocks. And lastly, we found some interesting data about the fund's top 10 holdings. We found that most of the top 10 stocks that the fund holds have done well. 3 stocks have delivered close to 40% return in 1 year. While others have also generated decent returns, all this could have contributed to the stellar returns generated by the fund. Using the same list, we decided to look at how many of these stocks are unique and contra. For this, we looked at how many flexi-cap schemes held any of these stocks. Now, we looked at flexi-cap schemes for a comparison because they can invest in stocks without any constraints. Now, what we found was that 5 of these 10 stocks are not that popular with flexi-cap funds. They are ONGC, Delivery, Gale, Cipla and Cognizant. So, this fund seems to be investing in stocks that are less popular among other schemes. Now, even though the fund is delivering good returns, let's look at risk profile of the scheme so you can decide if it is worth investing in this scheme or no. Now, in the previous sections, we saw that the fund has a higher than usual portfolio turnover ratio and higher exposure to mid and small cap stocks. Now, both these factors usually directly relate to a fund's risk profile. The higher these ratios, the higher the risk profile. However, surprisingly, the fund has managed to limit the downside risk. Why do we say that? Well, we looked at how the scheme performed when the markets correct. We looked at the period after 2018 since the new fund manager took over. In the 6 quarters when Nifty 50 gave negative returns, the scheme fell less than Nifty 50 in 5. This is initially surprising when considering the exposure the scheme has towards mid and small cap stocks. Now, this could be because of the fundamental construct of contra investing, wherein the margin of safety is more. However, do know that beyond the above metrics, contra funds come with their own set of risks. For example, it is challenging to identify a trend before the herd. Secondly, it is possible that the sector or the stock remains out of favor for a long period and that can lead to prolonged periods of underperformance. With this, we have come to the end of this video. I hope you found this video useful, and if you did, please share it with your friends and family. And don't forget to subscribe to our channel. I'll see you with a new video very soon. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.